Ladies and gentlemen, why don't we begin as the sun sets over the Pacific, we turn to the topic of housing finance. And we've gone a bit of the full gamut today. We started, of course, with a macro picture. We, of course, enjoyed the remarks of Ed Leamer, John Williams, all the rest. And now we turn, obviously, to housing and to housing finance. Now, going all the way back to Ed's remarks, Ed talked about the difficulty of forecasting in this environment, and in particular, issues that relate to discerning a new normal. We went from there to a John Williams who talked again about difficulties in normalization of monetary policy and the efforts to lift our risk-free rates off of zero and to create a monetary policy instrument that might be effective in the next downturn in the sense that we'd have positive interest rates to work with. We come from here to the issue of housing finance. And what I'd like to do today is to handle the housing finance issues at both a sort of a micro level and a macro level. And what I mean by that is I'd like to talk about instruments, I'd like to talk about originations, I'd like to talk about borrowers and all these dimensions. At the same time, there's a global context to all of this. And the global context is the housing finance system, a system in the United States that on the residential side is entirely in conservatorship and in the hands of the US government, entirely run by the GSEs, Fannie Mae and Freddie Mac, as well as Ginnie Mae. And in that particular respect, we have big questions to answer. Now, as you know, over the course of the post-recession period, we've been talking a lot about housing finance reform. We've been talking about the future of Fannie and Freddie. We've been talking about new entities. We've been talking about a new role for the US government. And we've been talking as well about the return of private mortgage securitization on the residential side. To date, none of that has come to bear. There have been many pieces of legislation introduced and none that have emerged. We hope to cover all of that. But what I'd like to do first is introduce the panel and begin in what I would call a logical framework. And in describing that framework, let me just say the following. Today, unlike the period leading up to the crash of housing and mortgage markets and the so-called Great Recession, today, in excess of 95% of everything we do in housing finance, be it in mortgage origination or in the secondary market in the form of mortgage securitization, is in the hands of the US government, is backed by the US government. In the primary market through conventional conforming mortgages and through the FHA, which together make up a market share of about 100%, and in the secondary market through the GSEs, Fannie Mae and Freddie Mac and Ginnie Mae, which again, together make up roughly 100%. Private mortgage origination is entirely limited today. Private mortgage securitization is essentially non-existent. From a systems approach, the question is very basic. It's whether your optimal housing finance system would be one that would exclude a private origination and securitization function. And yet, we're not there yet. We want to explore some of these issues. So the way we're going to do that is we're going to go through the comments of our three panelists, and I'm going to invite you at the end to share your questions with our panelists as well. But we're going to start with the biggest part of the story, which is what I would call conventional conforming origination that conforms to the underwriting guidelines of the government-sponsored enterprises, Fannie Mae and Freddie Mac. From there, we will go to innovation in terms of private origination and securitization. And finally, from there, we're going to go to the secondary market, to securitization, and to the future of the housing finance system. That's our game plan. We're going to start with Franco Tarango. Franco is seated in the middle of our three panelists. Franco comes to us today from the Bank of America. As you know, a literal behemoth in this space. And as you know, the entity that took on Countrywide and has attempted to digest Countrywide. Not an easy task for the Bank of America. Franco has been with the Bank of America for 30 years. He's risen through the ranks. He's now the senior executive in charge of residential mortgage finance for the Western United States. 1,000 people work for him in this function. And Franco, maybe the way to begin our session this afternoon is for you to say a few words about the so-called conventional conforming picture, how it conforms or deviates to what we saw pre-downturn, whether the spigot that we call liquidity in residential markets is about right, whether we see credit rationing or lack thereof, whether we need more liquidity or less liquidity. Maybe you can start us off and we'll kind of hone the questions from there.
Perfect. Thank you. Thanks for having me. Thanks for sticking around late in the afternoon here. As Stuart said, my name is Franco Tarango. I'm the divisional sales exec for the Southwest. I have been with Bank of America 30 years, despite how youthful I look. I think the fundamental question that Stuart is asking is, what is the credit picture for a consumer today? And I think, Stuart, you were saying, and compare that to where we were pre-crisis. And a couple things I would say is, first off, I think from a lending perspective, it's alive and well. There are a number of lenders, large lenders like Bank of America, smaller lenders, private lenders that are lending money today. The big differential, I think, that pre-crisis to where we are today is the expectations that we have from a consumer perspective. And that is not completely unchanged from pre-crisis. The expectations are always income, assets, liabilities. But the rigor around documentation is pretty strenuous today. And my advice, certainly for any consumer that's actually thinking about buying a home, is you have to get to a lender early and really understand the expectations that will guide you through the process. A good mortgage professional, whether it's with Bank of America or another lender, will guide you through that process, expectations of documentation that you will need to be able to qualify for a loan. And that is critical. Secondarily, but just as importantly, is getting with a real estate professional and understanding, once you know what you can afford from a home perspective, what type of neighborhoods in more of the subjective type things, schools, crime rates, things of that sort, that a real estate professional can help guide you in regards to neighborhoods. We've seen a shift and positive shifts in first-time home buyers continuing to increase year over year. We see a good mix of low to moderate to super affluent that are moving. The affordability issue, I think, is a real one, especially in the markets that we support here, and really all around the country. That affordability, continues to be, of primary concern. That said, I think there's some subjectivity to setting the proper expectations of not only what you can afford in a pragmatic sort of way. I likened it. I was talking to Stuart. I think I was telling you earlier, when I first bought my home, it was probably not the home that I dreamed I would be in, but moved into a home that I knew I can afford, and ultimately redid my roof, redid my paneling, redid my kitchen, all of those things that helped me along the way. And then ultimately, because residential mortgage is such a good investment, that helped from a liquidity standpoint in purchasing a future home and building and really growing in that continuum. So, I fundamentally feel that we're on the right path, but this we're very strenuous around documentation and understanding and putting people in homes that we want to ensure that they can sustain for the long term.
Okay. Let me turn next to Sean Miller. Sean is to Franco's right, and Sean is an innovator and an individual who started a number of very interesting and successful companies that operate in what we call the private mortgage origination and sometimes securitization space. And Sean is working with people who may not be working with the Bank of America. And he's working with instruments that may or may not be available at the Bank of America. So Sean's entity is called Five Arches, or Five Arch Funding Company. Its parent company is called Five Arches. Sean is CEO of both companies. It is a leading private originator, investor-focused residential lending company. So what Sean does is non-conforming loan products. He targets non-conforming borrowers. These include bridge loans. They include rental hold loans. They include flexible hold loans. And of course, he works with many institutional investors as well.
Thanks, Stuart. My partner and I are here today, and look, it's late in the day, and we'll tell you about our passion around real estate and around finance. At the end of the day, we look at it really quite simply. The oxygen for real estate is financing, period, end of story. We launched a distressed fund in 2007 before the Great Recession, and we flew around New York, London, and a few other cities, and we kept telling everybody what was going to happen. I said, well, we don't really see it that way. Well, within about a year from now, then we ended up raising well over $1 billion. And we went around and learned very quickly what the difference is between holding positions that are liquid and holding positions illiquid. And from meetings at the Federal Reserve, the Treasury, down to virtually every bank, every broker-dealer in the US, we learned very quickly that liquidity won the day and won the game. And from 2008 through 2012, we purchased about $5 billion in mortgage-backed securities or whole loans. And effectively, then we went to work as operators. And to the extent we could, we fixed the loans we could. And what we learned was when it comes to liquidity and capital, what's key is the efficiency of it and the sort of inexpensive nature of it. And what we learned over time was you start very slowly, you wait for a lemming mentality on Wall Street and others to follow, and then you act. And accordingly, we started to first trade some of those loans in whole loan fashion. Then after a while, when people started to see the performance, we would trade them in large bundles. Then we figured out how to put them in a non-rated security, and then we learned how to put them into a security. And the entire time while you're doing that, what you're in effect doing is creating more and more efficiency around the amount of sheer capital that's out in the universe and using it to get less and less expensive, better and better terms. To Stuart's point, in about 2012, we saw the sheer velocity of capital moving so quickly that to us it was no longer of great interest to be in the non-performing sector, but in fact to be in the performing sector. We chose, based on what the Fed was doing and the behavior of the US, a couple of very specific areas. We wanted to be short because we were unsure of where the economy was going to be. So fundamentally, one of our loan products is 1 year or less. And we wanted to build up an independent balance sheet so that we could test the thesis first ourselves, then take it out to a secondary market. So building a private mortgage franchise, as Stuart's saying, is really not much different than buying virtually and building any other business. We started by funding companies that fix and flip properties around the United States. They would buy a parcel, improve it, and then sell it back on the market. In 2013 and 14, that was predominantly financing persons who were buying distressed properties at a foreclosure sale or alike around the US. However, over the last 2.5 years, you've seen for the last 3 hours lots of discussions on what's going on nationally and then down to LA. We actually are living that reality, and we're seeing more and more competition for less and less supply out there. So in fact, what's happening now is instead of our borrower being someone going to a foreclosure sale to purchase a property, in fact, they're buying a property, what we like to call sort of the improvement or the infrastructure rehabilitation of cities like Los Angeles. So a perfect example would be a cottage that's 1,400 square feet. That property was built sometime in the early 1960s, and it's now ideally situated in a location that with a home of 1.5 or 2 times its size will sell for 2 or 3x. You can assume by the numbers you just heard for rental and for housing prices, there is an enormous arb there. So we spend an enormous amount of time financing those people. So once we finance them, we start to hold all this paper. Then the issue really becomes, what do we do with it? So at first what we do with it is we bundle those loans, generally in very small packages of 5, 10, 15 million, and we sell them no longer to banks, but we sell them to asset managers. Why? Banks have become effectively our friends in a much different way. We think Dodd-Frank has worked very well, but because it's worked so well, regulations have dramatically affected what they can or cannot buy and what they can or cannot invest in. So most of the time, the institution, the bank itself, is our financier, but never the buyer of the product. So now that we have our financing lined up, we then take all of those fix and flip loans, we bundle them together, and we go to fundamentally Wall Street or Los Angeles to where the largest asset managers are. Why do they want to meet with people like us and start with small numbers? Well, if you live in a world as we do now, where the effective return is zero, there is now desperation on the part of virtually every type of fixed income manager to need some type of yield to keep their job and sustain the cash flow on their portfolios. So we start off with very small tranches with them. They start to like the product that they get, and much like the lemming effect again, we work out much longer structures, much deeper and more complex structures. So inevitably, instead of selling them the entire loan, we may sell them 90% of it. We'll keep the bottom 10%, so there is an alignment feature between us. They know they can trust us because now we have a first loss position. It's compelling for us and our investors because we have an outsized return on our portion. We manage the assets, which gives us a great comfort, as well as our counterparty. That's an example of how, in sort of the private mortgage market, sort of how these things evolve. We do the same thing on longer dated products, 3, 5, and 7-year products, where you have, in fact, investors who now have aggregated tens or hundreds of single properties that they have in cash. They may go to a bank and say, hey, look, we'd like financing. For a variety of reasons, regulatory and operational, the bank may not be the most compelling choice. Instead, they'd like to go to a private financier like us. Again, we take that product and we then shift it, most of that balance sheet, to life insurance companies, broker-dealers, and asset managers. Got a little long-winded, but at least hopefully that's a little example of how we start and move through a private mortgage business.
Good deal. Thank you, Sean. We'll come back and pick up on many of those issues. Let me now introduce our third panelist. That's Professor Kerry Vandell of the University of California at Irvine. Kerry is a Dean's Professor of Finance down at UC Irvine. He's Director of the Real Estate Center down in Irvine and a very erudite author and scholar and observer of housing finance and of real estate finance more generally. Kerry, walk us through some of the issues that relate to residential secondary markets today.
I guess I could relate this in a saga. It's really a saga of the trials and tribulations of Freddie, Fannie et al. Over the last decade or so. For those of you that aren't really familiar with everything that's happened here, especially with respect to the secondary, residential secondary market since 2005 or so, it was a time of great wins and great losses and tremendous dislocations. Prior to the financial crisis, we were seeing what I thought, in fact, all of my projections were showing that we had at that time about 2/3 of all residential debt was securitized at that time, either conventional conforming and Freddie and Fannie, or with FHA and Ginnie Maes, or in the private label RMBS market, relatively small for most of that time. And about 75% of all new debt was being securitized. It looked as if securitization was going to be the wave of the future. It wouldn't crowd out everything. Obviously, there were certain home loans that would remain more desirable on the books of the individual lenders or others. But securitization was becoming a commodity almost, both in the private market and in conventional conforming, and certainly in Ginnie. So turn back to think about 2003, 2004. Remember, there was a growth in what we call the non-traditional mortgage products. That is your pay option ARMs, your Alt-A loans, your subprime lending, and a variety of other products, home equity line of credit and so forth, closed-end second loans, a number of products that were really not actively marketed and certainly were not, they tended to be securitized, or certain of these loans, especially subprime, tended to be almost wholly securitized, but it was a very small part of the market. Things changed pretty dramatically between 2003 and 2004. And it was a period of time in which Freddie and Fannie basically stepped back from the market. They had only a very small portion of the new securitization market and originations during that period. But the non-traditional private label issuers stepped into the void. So there was a dramatic increase during that period of time. So I remember one year subprime had something like 20% of the total market for originations. And that went on through 2006, 2007. Property values started to stabilize, stagnate around 2005, 2006. Started down. It was very uncertain for about a year or so as to what the future was going to be. I look back at my talks. Stuart, you probably look back at some of your talks at that time. And we were all pretty ambivalent about what was going to go on. Was there going to really be a significant break in the market? There had never been one that had been of any significant magnitude apart from the Great Depression. Or was it just a blip, stagnation? It turned out that many of the players in both the primary and the secondary mortgage market were running stress tests. These were the monoline insurers, all insurers of every type. They were the originators, the lenders, the non-bank mortgage banking firms, you name it. The conduits were all running their stress tests. And for the most part, they were running stress tests where the worst case scenario was possibly a 5 to 10% decline in property values, which would recover after 2 or 3 years and come back up gradually. Well, we saw the result of that. Property values declined by roughly 30 to 40% across the U.S. This was a systemic drop that had never been experienced before in the U.S. And of course, if these people had actually run their stress tests for that decline in property values, they would have experienced the same rate of default as was actually experienced. The bottom line is everything fell apart. I shouldn't say everything. The private labeled securities market essentially went to zero almost overnight. And even today, it's relatively small. The steps that Sean and his firm are taking are some of the initial steps to bring us back again. Jumbos are coming back. Most of those tend to be held in portfolio. There are some securities that are being offered now, but by and large, virtually nothing of the private label market is being originated again. I don't believe that's going to continue. We can discuss that later. But from the standpoint of the conventional conforming market, Freddie and Fannie really stepped into the void during that period of time. Freddie, Fannie, and the FHA, as was noted, their share of total originations increased during that period of time. Freddie and Fannie stepped back in to the void. And that's not to say they certainly didn't have problems. As you're well aware, they went into conservatorship 2009, was that right? I thought. In 2009, and basically cost the federal government something like $187+ billion. Nonetheless, they continued their activities under conservatorship. However, their share prices dropped down to essentially zero, apart from speculation. That's a whole different story we can get into later. But they were essentially government enterprises. So what was not just government-sponsored enterprises, but government enterprises. What was considered to be an implicit federal government guarantee became very explicit during that period of time. So that kept the residential mortgage market, at least that core part of it, through FHA and Freddie and Fannie, liquid. Nonetheless, there was a major push to eliminate Freddie and Fannie. And in fact, from certain quarters, there are arguments that Freddie and Fannie were the cause of the mortgage crisis, the financial crisis. I had occasion through numerous appearances and involvement in litigation over the last 4 or 5 years to actually, through discovery, get into the insides of all of this, review the reputable research literature that's been undertaken in these areas, do some research myself. I can say definitively, Freddie and Fannie did not cause the mortgage crisis. They were involved in the mortgage crisis, and there were certain activities they undertook that probably caused some exacerbation, but at the same time, they were the saviors of the residential mortgage market during that period of time and their continued involvement. Fast forward, by 2012, they were beginning to make a profit again, and I think just within the last year, they've essentially paid back something like $225 billion or so to the government now. They're still in conservatorship. They're making a hell of a lot of money for the government right now. We can talk about how the money's being used or may be used. We'll talk about their future maybe in further conversation, but I'll just say briefly, you will have Freddie and Fannie to kick around again, so in some form. Okay.
Okay, Kerry, thank you. Thank you for that overview. I want to, perhaps pose a couple of broad issues for the panel, and as I say, we can open it up subsequent there too. But if you look at the overview of the conference today, the conference begins with a rather positive story about the performance of the U.S. macroeconomy going forward. Relatively hopeful story about the normalization of monetary policy. And similarly, a hopeful story about the housing sector, where David Schulman told us that with some luck, we're going to get up to maybe 1.4, 1.5 million housing starts on an annual basis. At the same time, very salient to almost every presentation and every discussion has been a concern about housing affordability. And that concern relates to supply constraint as well. We heard it in the panel prior to this, and we heard about a variety of different initiatives that relate to densification and development and all the rest, and other potential non-starters that relate to enhancement to affordability. We also heard that this isn't an academic, esoteric topic of affordability. This topic of affordability is about the health and the economic well-being, the job growth, and the economic product of some of our major and more expensive cities. With that, the question to the panel. This is not a panel about housing economics, it's a panel about housing finance. What is there in the world of housing finance on the private side, on the government-backed side, in the secondary market, that we have to say about housing affordability, about addressing the affordability challenge? So Franco, for you, from the perspective of B of A, are there new instruments? Is there new underwriting? Are there new ways of looking at FICO scores? Are there new ways of looking at untraditional forms of earned income? Are there new other qualification tools that the B of A is interested in that may help to qualify additional borrowers? Sean, on your side, on the private side, where are the innovations? What are the possible innovations? And how might we, through housing finance, and similarly, Kerry, what's being done on a more global level? Where are the innovations? We here at UCLA last week, as I think was mentioned, had a big academic conference on issues of housing affordability. We're trying to gather some steam here. So gentlemen, go at it. Tell us how to address this affordability challenge.
So I'll give you a couple of high points about what we see on our side and how it ties back into the macro. The macro is pretty simple, right? Effectively, every institution, federal or state or otherwise, has this ability to borrow money at virtually these unheralded low rates. And you have a ability and now a consciousness to have this sort of very inexpensive cost of funds. And for Fannie and Freddie and now FHA, the thesis is really simple. They cannot go through another process, as Kerry's talking about before, where they've egg on their face and they have a 22% default rate and another 10 years of cleanup. So they keep credit as tight as they possibly can. You either qualify or you don't. It is a zero-sum game. So for those who qualify, this is the all-time best time, right, obviously in the last 40 years, to purchase a house using this inexpensive debt. The problem at the same time as that is there's a few other issues which fundamentally the country doesn't really want to deal with, and everyone thinks housing is immune to it, but it's a part and parcel of it, which is we have an aging population, we have a population that needs to be around where they work, around where their kids go to school, and fundamentally, we are in no position to address how to deal with that at this time. So the alternatives that are in the world we live right now are not necessarily short-lived, but they are small compared to the scale of what we're talking about. There is currently over 10 trillion outstanding of Fannie, Freddie, and FHA paper now. Historically, they're supposed to be generating about $1 trillion of it. Right now, at most, you're at pace to generate less than half of that. So all of a sudden, on the demand side from investors, there's not enough bonds, securities being created. So mortgage REITs, asset managers are all looking and buying the same product, which is compressing down rates further and further, which in an indirect way actually exacerbates this problem. On the private side, you have smaller groups like ours and larger groups like a Blackstone, for instance, and if you saw last week, a Colony effective merger with Sternlicht, which is there's now the ability, as you heard this morning, to start real securitization around the single-family rental business. It certainly, on a buy side from an asset manager, will be very small compared to Fannie, Freddie, and FHA for some time to come, but it at least is now an expression that there are multiple tens of billions out there of securities that will be formed. The difference, and still the problem is, marrying that, call it 50 to even 100 billion a year, with where we need to be on allowing sort of a more loose concept of credit again, is political will. Who is actually going to stand up on the debates in either Republican or Democratic Party and say what we heard said in the mid and late 90s, which is everyone needs a home, or 70% ownership. We have ownership, David was showing before, at 63 spot 2 on its way to 60, which is going to be World War II timeline, and there's not one politician talking about it. Well, there's a reason why, because nobody at the moment still wants to get out in front of that issue. And until they do, we are really kicking down the can a lot of these issues.
So I greatly agree with much of what you said, Sean, and I think you raised some very good points. The opportunity I think we have in the banking industry is a couple-fold. One, I should probably level set that, one, we have a large portfolio, so you've got some latitude when you have a portfolio in how you utilize it. 34% of all of our lending happens today in the LMI arena, so that continues to be a very solid area that we can lend in, even within the parameters that are set. We have an additional 40% that are done from a jumbo space perspective, and unlike what Sean does, ours is very much more specific around primary homes, where single-family homes and condos where people, their primary residence is, and/or second homes. So it's not on as much on the investment side as probably much of what your business is. You know, ultimately, it's leveraging back to the portfolio piece. How do we leverage the portfolio and looking at a client and outside of the box that's laid out from the GSEs or in the government lending space, and say the complexity of this borrower is such that we will look at their deposits, we'll look at their credit history, we'll look at their investments, and make a rational judgment on credit based upon that. Always with the underpinning fundamentals of their ability to repay and long-term sustainability in the house. So, you know, we'll have a much rigor around that. But looking outside the standard parameters, Stuart, I think is what you were addressing, that we have today, whether it's in the conforming space and certainly in the non-conforming space, which, you know, we look at from a QM perspective.
From a more macro perspective, I think the primary role that the housing finance system has in affordability is really through the process of securitization itself. As I think it was David mentioned, the efficiency of delivery of capital, that's what this whole system was all about. There's nothing fundamentally wrong with securitization and the securitization process. It's able to bundle together a lot of assets. It can provide diversification advantage. It can efficiently move that capital to larger groups and differentiated groups of investors through proper tranching, credit risk evaluation and allocation. It can sell those assets at particular prices, those tranches, to the appropriate class. Nothing has changed in that regard, and I think it's still a very, very legitimate sort of process for delivery of capital and enhancing efficiency of the delivery of capital, especially to the subprime market. I hate to say it, but I'll go on record. I'm a believer in the future of subprime and novel new private label instruments as they evolve, such as those that Sean's group is involved with. Those will gradually come back. I think there's going to be much higher degree of oversight over those, both from government, from other agencies. There's going to be much more risk sharing that goes on, where there will be skin in the game by the various parties involved to reduce any sort of adverse incentives or lack of transparency out there. But I do believe that those will come back, and the market will demand that in the long run.
Okay, very well. Just to drill down here a little bit, you know, when we talk about non-GSE instruments and we talk about non-GSE securitization, we cover a gamut. And that gamut has been mentioned by all of you, and that gamut includes the traditional subprime borrower. And of course, there is an argument, as you've made, Kerry, or Sean, you've made, for the provision of credit to the subprime borrower. In addition to that, there are prime jumbo borrowers. And as I think we heard from Franco previously, or as we know, there's no securitization outlet for prime jumbo mortgages. So for example, the Bank of America is holding year after year after year, in the spirit of Jimmy Stewart and It's a Wonderful Life, is holding more and more of these prime jumbo mortgages on their books, with no capital markets outlet.
Well, you know, I think, just to chime in on that for 1 sec, I think
Sure.
not necessarily about B of A, but I think the jumbo prime product to a very large degree has now become a, let's call it, entry or gateway product for banks with high net worth individuals. So a lot of times now, I think, and again, I don't know the culture for B of A in particular, but many private banks, whether it could be a Morgan Stanley or a Goldman, will lead with their balance sheet, because if they can effectively use a commodity, which is cheap capital, to attract your other assets to the institution, they are certainly, Stuart, not going to put those in a securitization and lose the asset management or the texture or the relationship with the borrower. So I think the jumbo prime, certainly with people with some asset base, has become a very peculiar apparatus, when in essence, it's really no longer even a mortgage. It's just the easiest way for the institution to lend some money and attach themselves to a company or individuals.
Sean, certainly a legitimate point in terms of cross-marketing of products. That said, however, there is this expectation that we would see a private securitization on the jumbo side, and that this would be helpful, as point Kerry is making, to the overall efficiency of credit allocation to residential real estate. And I'm wondering, Franco or Kerry or whoever, is this on the horizon? Is this with the caveat that Sean brings forward? Is there some expectation that we're going to see some of this? I mean, my understanding actually was that the B of A was originating these loans, putting them into portfolio with the expectation that some years down the road, this was where the private securitization market would restart, with prime loans, not with subprime loans.
Stuart, I'd say that's exactly it. I mean, right now we're in a position, from a hold position, in what we utilize our portfolio for today. I do want to address a little bit of what Sean had spoken about. You know, during the crisis and early on, before the crisis, we were one of the only lenders that actually had a portfolio that we were still doing business in that non-conforming segment, outside of just for our clients. I mean, we're supporting that sector from a portfolio perspective early on. I've always found, 30 years in consumer banking and 20 years in the mortgage side, that mortgage is ultimately a foundational product to the consumer as a whole. So, I think that certainly is our position as a company today, is that it is a foundational product to build relationships on, but it's a continuum of relationships. It's from new doctors to affluent customers and everywhere in between. And so it's good business, I think, to Sean's point, but it's good for the consumer, ultimately as well. I believe, right now, the whole position is very profitable when we talk about the yields. So it's a great position to hold today. Though we would love to be able to see, a vibrant secondary market emerge and participate, long-term in that. But Kerry, you're more the expert here.
No, I feel the same way. I think that's certainly, and that's what occurred originally back in the, 70s and 80s when we first started seeing some of this. I mean, the conventional conforming was there, but it was the jumbo part of the private market that really started first before we moved to subprime and some of the other non-traditional sectors. We started talking about affordability, and somehow we've moved to the high net worth individuals. I don't know. I wanted to try to move the needle a bit back to affordability and issues and the role of the secondary market in that regard. One thing I think no one has mentioned yet is, and it's a major discussion I know in Washington, is what's going to happen to the federal, I've forgotten exactly, low-income housing trust fund, which a portion of the G fees, I believe, or the earnings of Freddie and Fannie were placed into that. And I think Mel Watt earlier this year ordered that to be restarted and recontributed, but there's a big argument. Depends on what happens to Freddie and Fannie in the end. Will they become essentially the equivalent of an FDIC for the sort of an insurance backstop funded through members' contributions? That seemed, at least with Corker Warner, to be the sort of outcome, but it's very uncertain right now what's going to go on with all of that, what's going to go on with Freddie and Fannie's multifamily business. They just seem to be lower on the radar screen relative to immigration and some of the other issues that have taken center stage now.
The solution a little bit on affordability was the slides that were up here in the last presentation also. You had 4 years of a dearth of new home building. It's picked up to about 1.4, 1.5 million units now, which is getting back to average. That means you're really much further behind than you think, because over the last 7 years, you've had population increase. So while you've had more and more families, you've had less, production. So really what will happen is, as that supply channel starts to fill out, assuming Fannie, Freddie, or private comes in, you'll have a lot more product, which fundamentally should ease a lot of the affordability or pricing aspect, certainly more than what we're talking about, which is incremental basis points on all-time low rates anyway. So that'll probably have a big part of it, I think, from a financing standpoint for people in the audience. My gut is, if I was betting, some of the home builders out there, some of the more sophisticated ones, will probably now start to put financing on their own portfolios and their own products. They know who their customer is that they're selling to. Why wouldn't they provide them financing as sort of the most potentially efficient way, certainly in a private market, to start to really start financing just like any of us would do conventionally on just seller financing.
Very well. Gentlemen and ladies and gentlemen, we're almost out of time. I have a couple of really one-word type answer questions for our panel, and then maybe we'll have time for a question or two. But in one word or less, gentlemen, is GSE reform dead for the remainder of the Obama administration?
Yes.
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 Okay. In one or two words, do we expect any numerically meaningful private securitization to be occurring over the remainder of the Obama administration?
No.
I don't know.
Don't know.
Okay.
2 words.
I'm going to vote. I'm
Yeah,
going to
he
vote.
said
I'm going to vote
two
no
words.
as well. Okay. A quick question before we depart, Ed.
Yeah, I have a question. I haven't heard anything about innovations that are in the interest of the borrower. So think about the Greek debt. The ideal solution might be to have the interest payments super GDP growth, then you'll pay more to Jim, less otherwise. When it comes to student debt, a lot of people are talking about having that indexed to income
Right.
levels. So if you have great income levels, then you pay more. Housing ought to be indexed to like a Case-Shiller housing index.
I wrote my dissertation on that 30 years ago. I had what was an income-linked mortgage, and my advisor, Art Solomon, who some of you might know, told me they would never occur. So it is true that there are certain types of instruments that could be more responsive to the realities of this. All of that has to be priced, though. I mean, you have to look
Right.
not only at credit risk, you have to look at prepayment risk associated with each of these to help to price. I mean, these are the embedded options within the mortgage, and those have to be priced in an appropriate sort of way. The reality of the marketplace then determines as to whether this is a viable instrument and whether it's competitive. You know, that is, what interest rate would be required in order to compensate for the risk that's being borne. There have been a number of instrument types that have been proposed. I know the AEI and Edward Pinto has been most vocal about a 15-year rapid equity buildup loan. With that, I mean, my brief look at it, I know the Urban Institute has looked at that also, you're trading off various things there. You might build up equity more quickly, but to the extent that you've lowered loan-to-value ratio considerably at that time, you haven't done much, you've adversely affected credit risk. So you have to price both of those sorts of things simultaneously. There was even one, some of you might have read it, Dane County, Wisconsin, United Way is starting to sell a new mortgage product. Everyone's coming out with something that they feel will make some sort of difference. The reality is, I don't want to say that this is equivalent to cold fusion. That is, it's going to be virtually impossible to create something like this, but you have to recognize all the sort of unanticipated consequences and anticipated consequences for pricing that go on when you create these new products.
Yeah, let me say, people don't want to buy fire insurance either for the same reason.
Right.
Maybe they need to know the risks.
Bob Schiller could not understand why people didn't want to buy equity insurance. And they should now, right? Do they? No. No.
Okay, ladies and gentlemen, speaking of which, as Ed indicated, better education, we at the University of California at UCLA are delighted to serve the public mission and to engage in the furtherance of discourse as exhibited here today, and a forecast which is unique amongst economic forecasts in this country, because it is not a forecast that is beholden to any corporate interest. It is a forecast which is a straight call based on a straight review, and a very intelligent review at that. So I'd like you to join me in thanking the UCLA Anderson Forecast, the UCLA Ziman Center for Real Estate, the sponsors of today's event, Alan Matkins, MBK Real Estate Companies, the Irvine Company, the California Association of Realtors, Ferris Lee Investments, and of course our distinguished panel. And ladies and gentlemen, have a safe drive home. Thank you.